Hi, and welcome back to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And this is where every week we take a deep dive into everything financial. And this week we're going to be talking about our number one question that we get answered as financial advisors, which is, what do I do or how do I invest my money? Now we're going to break this down into three different videos just to be a little more specific to different situations. We're going to look at larger sums of money. Today we're going to be talking about part one, we'll talk about the larger sums. We'll use $1 million as an example. Our next part, we'll talk about 100,000, which can be applied to mid-range investment. And for those starting out, we're going to talk about 5,000, which are probably one of the most important areas to really pay attention to, because that's where people can probably make the biggest errors was when you're first starting out. But today we're going to be talking about the larger sum, $1 million, and that could be something either your current portfolio, maybe it's a new injection, you sold a property or got an inheritance, but we're just going to use as a general sum. So before we take that dive, let's as always remember, this video and everything in it is for information only. Do not take it as advice for your specific situation. Always seek out the advice or consult a professional, or do your own due diligence before taking on any investment strategy or any portfolio strategies that you might hear about here or anywhere else. Make sure you do your due diligence. So with that, let's dive right into things. So when people ask, how do I invest my money? Most of the time, what they're really asking us is what type of positions to buy in that portfolio. What types of things should be buying in that portfolio? So I'm going to put aside for a minute your financial plan or your investment goals and your risk parameters, because all those things should be addressed 100% beforehand. Not going to talk about it today because we've done a whole video on that. Recommend you go watch that after this, or even pause here, go watch it. Really important to have that in place before you look at what you're actually going to do with the money afterwards. So once you've gotten all out of the way, and then you sit down, you start to build a portfolio. Larger portfolios, diversification is very important. So obviously, we're going to be looking at a lot of different areas of the markets, different types of investments that you want to put in there. But how you start to build that out is really look at, first of all, what dollars you're going to spend this into. Because at the end of the day, if you're going to spend this money or the returns from this in Canadian dollars, you're going to have what we call a domestic bias. So you're going to want to have a large part of the portfolio, or a good part of the portfolio, in Canadian dollars, or at least hedged to Canadian dollars. Of course, when you take on foreign investments, you're taking on currency risk as well, which is an added layer into the portfolio. From there, you want to break it up into risk investments, less risk investments, higher risk investments, and there's a big, huge mid-tier range in there. You're also going to want to layer in there categories that we call alternative investing, and that could be what's sometimes called hedge type of investments, or even alternatives such as private, when you're talking about your debt portfolio, especially these days with interest rates being so low. Taking on some alternative debt, maybe some private debt portfolios, you can definitely get some higher yields in there with potentially less risk in the portfolio than you traditionally take. So those are all things to take into consideration. And why I cover all these different areas, because you really have to look at the different pieces that you're going to put into this portfolio that are going to complement not just how your portfolio grows, but how they interact with each other. Diversification, of course, we talk about all the time, but what we really mean by that is how those investments act at different times. So if you go out and you buy the NASDAQ 100 and you buy all 100 names of the NASDAQ, those are some really great companies in there. You'll have a really strong portfolio if you're in a growth market. But all those names are generally going to be technology oriented, and they're all going to go down at the same time and probably at the same rate. You're not getting that offsetting correlation. So it's really important to diversify your sectors. You don't have to be in all sectors. If you really don't like a particular sector, maybe you're against sin stocks, maybe you don't want to have, the alcohols and tobaccos in there, that's fine. You can take out sectors, but really make sure you've got a good diversification of sectors that have low correlation. Negative correlation is great, but low correlation to each other, meaning that they can be protective. Great example of that is your financials versus your energies. They tend to, on longer term, be a little bit offsetting. Sometimes we go through periods like a recession, especially here in Canada, where they can positively correlate, but just make sure you have a lot of different sectors represented in your portfolio. Should have a couple names from each sector at least. That gives you diversification within the sector. If it's a heavier weighted sector, even 3 or 4 names is great. Don't be afraid to use ETF, exchange traded funds, into larger portfolios. They are very, very low cost these days, and they can give you access to foreign markets. They can give you sector allocations. Another great thing to have in most portfolios, especially today where we're looking at inflation rearing its ugly head again. Gold in there. Sometimes if you just want to pick one gold name or 2 gold names and take the risk on what could happen at those particular operations, you can put it in an XGD, which is a gold, a broad gold index that gives you broader exposure to that sector, but will give you a very similar performance overall. So always consider your ETFs in even larger portfolios. I wouldn't exclusively use them, and that's just for tax management, but they can be very powerful when it comes to diversification to costly markets if you want overseas access. I don't use mutual funds very much in a larger portfolio just because of their cost. Not that I have anything against mutual funds. Their cost structure is a bit higher. And why pay extra fees when you don't have to, if you can replicate, especially if you're looking at North American markets. You can pretty much get access to all the things they have access to. So you could replicate that quite easily within the portfolio. So if you're looking at your Canadian portion, Canada's not a large market in general. In fact, if you're looking at an ETF in Canada, the TSX 60 is probably your best one. It gives you the 60 largest companies in Canada. That's going to be very heavy bank weighted in Canada, and that's just because the banks represent about 25% of our economy, so they're going to be in there. But if you want that bank exposure, it's a good one to have in there. And other than that, in Canada, you want to have some individual names, because that's where you're going to be very targeted in certain sectors or certain growth stories that you want to get behind. And now remember, if you're building a larger portfolio, even if you're more risk adverse, there's nothing wrong with having some speculative names in there. They don't have to be startup companies. They don't have to be what's called penny stocks, but just some higher growth names that can really add some extra returns to the portfolio. They might be very lightly weighted, 1 or 2% inside the portfolio. So you'll still get some really good names, really good growth. But if something goes wrong in those names, you're not going to damage your overall returns or your long-term aspect of the portfolio. So I do recommend, unless you're really against it, you have some of those names in there as well. That's the same from the U.S. side, especially in the U.S. side, because their smaller companies are a lot larger than our companies. And again, you don't have to be speculative. You just be more growth oriented. If you watch any of my other videos or weekly updates, I tend to focus on companies that are less outside the sexy side, right? So not necessarily buying the Shopifys in Canada or the Amazons in the US, which can get really overvalued really fast and have a bit more volatility. Not to say they're not great companies and they haven't performed exceptionally well, but you can play the side service of those businesses. So if you like a particular industry or you like a particular sector, you don't always have to buy the individual name. So take Shopify or Amazon, great names. We chose to play the side play of that, a little more diverse. We played Visa and MasterCard. So why Visa and MasterCard? Well, one, they're considered tech names in themselves. They're not considered financials. They don't own any debt. They simply provide the service where you swipe the card, they make money. But if Shopify and Amazon, so people are paying online, PayPal's another name that we have in the portfolios these days, all those are going to benefit from more online shopping. So if you're looking at technologies that you think more and more people are going to be online shopping and you want to pick the next Amazon, well, that's a really difficult pick. And if you get it wrong, it's going to be a loss in the portfolio. And it's hard to break in. Shopify's done a great job. But if you're counting on that someone's going to be the next Amazon, or Amazon and Shopify are going to continue to grow, all three of those names as online pay structures are going to benefit. So there's a lot of ways you can look at what service in the industry you're looking for. We've talked about 5G in previous videos. It's a great future technology to consider. But if you don't want to try to pick the next winner in 5G, you can look at service companies that service those types of sectors. And there's the cell sites, the poles that the cell towers have to be put on. The real estate that's going to benefit from that. There's all those different side aspects you can look at, or you can even look at the hardware manufacturers as opposed to the ones who are rolling it out. So always consider the less attractive, the less spotlight part of a sector that you're looking at. By adding those names in there, you can have a really, really strong portfolio with much less volatility, but the same kind of growth you're looking for in the long run. On the fixed income side, what you traditionally look at bonds. Tough market for bonds these days with the fallen interest rate and the yield curve not being very attractive. So you look at alternatives. Definitely consider alternatives. There's a lot out there, very broad, everything from spread trades to, as I said, private at the beginning, some private debt issuers. But do look outside the box. They don't mean risky. You do have to do a lot of due diligence to find the right ones and make sure you fit it into that portfolio. Again, I wouldn't really go to the mutual fund side of things. I know some financial institutions, especially the big banks, will have their in-house specialty pool funds. Don't like them in general. There's a lot of fees upon fees wrapped in there. They're also very not tailor-made to your particular situation. You might have to deal with taxation issues, and you obviously have a lot more flexibility if you're doing individual names or a portfolio tailored to you as opposed to the pools. So not a big fan in bigger portfolios of that. If you're in there and you have some questions about what yours looks like or the pros and cons of what you're in, by all means, be happy to do a glance at that and give you a second opinion on it. But I generally wouldn't use those there. ETFs are much more powerful, and again, you can manage them quite a bit better around your own individual situation and taxation. With taxation in mind, we do look at funds in special situations. If you're a corporate owner, business owner, there are certain rules like passive income rules and certain capital gains rules that we can actually use the fund structure to your advantage, so it offsets the higher fees that you're going to be paying. And there's also certain alternative strategies where the fund or pool structure might make sense. So I don't want to say you shouldn't have them in there at all. They might serve a purpose, but make sure, again, as we said at the start, you've sought your advice and you've done your due diligence to make sure that they're there for you. So that's where I'm going to round it off today. As always, subscribe to our channel, subscribe to our weekly report. We get these out about once a week. We took a little bit of time off this summer. I filmed out to the side today just to take advantage of the last couple of weeks of summer that we have left. Hopefully you enjoyed that. Anyway, love to hear from you. Thanks for watching, and we'll talk again soon. Thank you.